Hi, everyone. Welcome to Unhyped Stocks. Today, I'm going to show you stockanalysis.com. This website I use personally for pretty much most of my stock research. I've used it for years. I've spent hundreds, if not thousands of years with the platform working on it. And pretty much every single day, if I want to keep up on my investable universe, which is about 180 stocks that I follow and currently invested in about 40 of them, I just use stock analysis, and I will show you the watch list later. But first, I want to show you how you can actually find new stocks to add or create an investable universe for yourself. So we're going to be using the stock screener. Obviously, there are thousands and thousands of stocks you can invest in just from the American stock exchanges. It's like more than 5,000. So I'm not going to research all of them. I want to eliminate most of them. I know what I want to invest. First, before you even look for stocks, you have to know philosophically what you want to invest in. So just a quick example, I want high gross margins, high operating margins, high return on invested capital, low debt, low stock-based compensation, decent to high revenue growth, and metrics like these. And then also, this is just the numbers, and then also philosophy is much more important than everything else. A company could have the most amazing numbers and still would fail as an investment, would not get into the investable universe just because it fails philosophically. Maybe it just doesn't have a good, strong enough moat. Maybe the switching costs are low or non-existent, and just stuff like that. There are many philosophical filters that you can use, and obviously most of the philosophical filters that I use I've taken and learned from greatest investors of all time: Warren Buffett, Peter Lynch, Charlie Munger, David Tepper, Howard Marks, Seth Klarman, and many others. So let's get into it. Let's if you go here on the left, click on stocks, a list is going to expand, and we're going to click on stock screener. We're going to remove all of the filters, and we're just going to add one by one, and I'll show you what pretty much you need. Okay, we're going to go to the filters tab, and we're just going to add the market cap. Let's see. So we have here 5,600 stocks. Biggest one, NVIDIA, $5.4 trillion. So we added this filter, and let's just put a value on this filter. Let's say over $1 billion. Seems about right. I mean, you don't want to mess around with penny stocks or very young companies or old companies that are very low market cap because they have had a lot of time to grow and they haven't. So anything under 1 billion, I'm just going to ignore. Over $1 billion, immediately more than half of the stocks have disappeared from the United States stock exchanges. As you can see here, exchange country, United States. If you're from another country, you can just choose your country and research stocks from that specific country. This is what I like about stock analysis. It just gives you all of the numbers for every single stock you can find out there. I'm from Romania. I can look at Romanian stocks and I can look at the numbers, and it's great. I mean, there aren't a lot of sites that can offer this information to me. Let's see another filter. So revenue growth is the next one, just because this is pretty much the first number that you get to use on most sites, and on this one included. And also the earnings report comes in with a revenue growth first. So let's just put revenue growth. The 5-year average, I don't like to use the last year growth. Could be like outlier. So I'm looking at over the past 5 years on average in percentages. What did the company do? So NVIDIA, 65% on average. That's ridiculous. That is absurd. But let's filter this out and put, we don't really want to have flat revenue growth. Sometimes we do if we're looking for a cash cow, such as Altria. So Altria has pretty much no top line growth, but it pays 7% in dividend and also 4 to 5% in stock buybacks. So the yield is pretty much always over 10%. So it also has a very high return on capital invested. So that company is a cash cow, but let's just say more than 3%, over 3%, just to cover inflation. Let's just say 4%. So we already eliminated like 800 more stocks just by putting over 4% revenue top line growth. That's not a lot, okay? Over the past 5 years, remember, So over the past, yeah, there's just not a lot. 4%. It's actually mediocre. But yeah, we eliminated a lot of mediocre, low to no growth stocks such as Kellogg's, or I don't know what else could be in there. Let's now look at the gross margins and operating margins as well. So the average for the S&P 500 when it comes to gross margins over the past 5 years is like 45%. Before it was like 43. So let's just put over 35, just because a company has a little bit lower gross margin than the S&P average doesn't mean that it's a bad company. You could have a good company with 30% gross margins as well. So I don't want to, but I still don't want to go down to like automakers and very high capital intensive businesses. I want to have high gross margins on average in my portfolio, ideally much more than 45%, just to create a high quality a high quality portfolio compared to the S&P 500, because S&P 500 does contain a lot of high quality businesses. So if you want to outperform, go outside of the index and pick individual stocks, you need to have even better quality in your portfolio on average compared to the S&P. So let's just put over 35%, and we're going to be careful to have most of our stocks, most of the money that we allocate into stocks that have more than 50% gross margins. Operating margins, on average, S&P 500 is around 15%. We're going to put over 10% here. So we only used 4 very simple filters, and out of 5,600 stocks, we're left with 800. So already, as you can see, we haven't even filtered aggressively, and most of the stocks are gone. So, I mean, that's how ruthless you have to be. But we're going to add some even more filters. Let's see. ROIC, return on invested capital. This is a very important number. And we're going to use the average for the past 5 years if we can, because this number can fluctuate. Maybe 1 year is negative for a company, but that doesn't mean that the company is bad or anything like that. So we want to have, let's just say, over 8%. I think the average for the S&P 500 is over 8%, but yeah, 8% is decent. At around 10% average, you start to compound nicely. Anything over 10%, you're doing like a really high rate of compounding. And yeah, we're going to have some companies that have ROIC in the 30s and 40s, and some that have in the low teens, and that's fine. Just the average we want to have over 8%, which is the average of the S&P 500. So we're going to save that. Again, we're down to 460 stocks. ROCE as well. Let's just put this over 0 to see how many stocks we kill off. Just 10. Okay, let's see, over 5. Okay, that's fine. So just using basic filtering, basic numbers, we have eliminated more than 90%. SBC, stock-based compensation, is very important. You don't want to have excessive stock-based compensation, because if you have a lot of top-line growth and the margins suck, and you have very high SBC and the company is constantly diluting, so it just offers you growth, but at a huge cost and no return to you as an investor. So you want to stay away from very high stock-based compensation. But you don't just want to put like expenses here, stock-based compensation, as a raw number, because it's just going to show you the raw amount of dollars given out in stock-based compensation. You want to have a relation such as SBC to revenue, or SBC to net income, or to free cash flow. You want to have percentages so you can compare between companies. You want to have some kind of understanding how big the stock-based compensation is in relation to the business. And then you can compare to other companies as well, such as, well, NVIDIA has 2.7% SBC to revenue. Google has 6.3%. So yes, NVIDIA is a tech company. It does a lot of stock-based compensation, but it's not excessive. It's the biggest company in the world, extremely high-tech semiconductors, and Google has a much larger SBC to revenue in percentage terms than NVIDIA. So you can just look around here. Broadcom, 11%. That Meta, 11%. That's, I mean, I'm gonna have to have the rest of the numbers look like stellar. They have to be impeccable, and also the valuation has to be a bit lower for Meta in order for me to buy this company over something like Microsoft, just because, I mean, they're giving out shares to employees and management like it's candy. So SBC to revenue, let's just say under 15% seems reasonable. Add filters, SBC, what else? Debt, we're interested in debt. So cash to something, overall cash and debt here, total cash, net cash, cash to market cap. Again, another ratio, another number that is given in percentages. So here, as you can see, most are positive. So they are net cash positive in terms of how much their cash is worth divided by the market cap. So these guys are net cash positive. Let's just filter out. If a company is negative in cash, it doesn't mean that it's necessarily bad, but you don't want to have 200%, 300%, or 500% of the total market cap in debt. So let's say a company is worth 10 billion in market cap, and they have 50 billion in debt. That's just not going to be very exciting to buy and hold. You want to have growth. You want to have good margins, returns on capital employed, low SBC, good cash reserves, low debt. So that's how we eliminate most of the stocks listed on the US stock exchanges. So let's just say between minus 30% and 100%. That's going to be fine. And that gives us, if the company has more than the market cap in cash, that's kind of either some weird thing going on where it's a holding company or something like that. For example, Berkshire Hathaway has like 400 billion in cash and treasuries, and the market cap is like 1 trillion. So that's like 40%, which is excessive. You want the company to take that cash and put it to work. You don't want to have a company that doesn't make any kind of acquisitions or doesn't do buybacks or just keeps the cash rotting away in some bank account. You want your company to compound, to keep expanding and growing and find new revenue streams and new markets and new ways to make money. So if you have excessive cash to market cap, that's also not a good sign. But also, if it goes very deep into debt, if it's a very high capital intensive business, you don't want to have that either going for it. So what else? We put in a lot of filters now. Let's just put some kind of price action here. Let's just say 52-week low, price change 52-week low and 52-week high. So what does this mean? 52-week low, it means how much higher it is from the lows. So NVIDIA is 36% higher today in price than it was from the lows and is 5% lower from the top. So it would be a very, I won't say very bad, but quite bad timing to just buy NVIDIA now. It's quite high from the lows and very close to the top. So we're going to be looking at something else. Maybe we find here something that I don't currently own in my investable universe. I have pretty much all of these, obviously, tech stocks, NVIDIA, Apple, Google, Microsoft, Amazon. I just closed my Amazon and Microsoft, closed Amazon like 275 or so. Closed Microsoft from like, I had it from 350, closed it to when it was close to 500. Pretty much all of these are part of my investable universe. Eli Lilly is not, just because it's a biotech company. Also, it's 93% up from the lows, and it's at all-time high currently. But yeah, what else do we have? Let's just find something else. Cisco, Applied Materials, Lam Research. Let's put in more rows here. CVX is not part of my investable universe. It's an oil company. I don't invest in the oil industry, in the energy industry, unless it's like some very high choke point, some kind of picks and shovels type of business that sells to the oil industries. Netflix, as you can see, it's down 41% from the 52-week high, and it's jumped only 14% from the bottom. Wouldn't be a bad entry right now, but just the fact that Netflix completely fails philosophically, I'm just not going to touch it. I made a video about this last year. It was over $100. Now it's like a 70 or something, 75. And I said I wouldn't touch this. I mean, it's just a very bad neighborhood. Netflix lives in a very bad neighborhood. Amazon Prime, Apple TV, HBO Max. What else is there? I mean, a lot of streaming companies, even Google with YouTube gets a lot of view time from Netflix. The switching costs are non-existent. People can just switch immediately. The library keeps expanding for the competitors. So, I mean, I don't know where this is going to go, but yeah, revenue growth average 11%, 12% last 5 years. Not so excited about that. Growth margins and operating margins look good, but also the moat is just not strong enough. These can drop like a rock immediately, and you can lose a lot of money on it, of course. Let's see here. Let's go on. Maybe we find something. So most of these companies I already have in my investable universe, except Amgen, IBM, Lin. This is a German company, I think. This is Linde, some materials company, Amphenol, Novo Nordisk, McDonald's, let's see, PepsiCo, Blackstone, Eaton Corporation, Railroad, Qualcomm, Bookings. Let's see here, minus 30, minus 33%. Intuitive Surgical, that's interesting. Revenue growth, last 5 years, 16%. That's solid. Positive cash to market cap. SBC to revenue, quite high. This is not a tech company. Actually, you could say it does have technology to it. It's a medical devices company. Very nice ROC and ROC. Yeah, not bad. Minus 33%. We're gonna look into it later, but let's see. Maybe we find something interesting that's at the bottom of the 52. Oh, look at this, 0.19. What is this? App 101 billion. What is this? App Lovin, I think. Revenue growth 5 years, 25%. Gross margins super high, next to my Adobe. Actually, that's interesting. But operating margins is more than double than my Adobe. Adobe, I have a lot of money invested right now. I'm gonna make a video later about Adobe. ROC, ROIC 33%, ROC 75%. Wow, this is amazing. SBC is quite low, 4%. I think this is a tech company. It's not excessive, much lower than my Adobe. And no debt problems, no debt load. They have a lot of cash, and they are pretty much at the bottom right now, today probably. 52-week low today, and 52-week high was 59% ago. It's like it dropped 60% in price. So we're gonna take a look at I don't want to turn this into a dip finder, but this is pretty much an excellent stock to look at because it's down massively from the 52-week high, and we're just gonna look at it. So Apple Lovin, let's see here, market cap, yeah, down 5% today. Let's see over the past 5 days, yeah, down 27%. I'm already getting pumped because the margins look great. Revenue growth looks amazing. Net income 4 billion for this market cap. Yeah, it still has ways to go. There's still a lot of air probably. So if there are problems, if the market anticipates problem with this company, it could go down a lot more. Let's see here. So yeah, all-time high is down. It's down a lot from all-time high, more than 60%, I think. Yeah, on the graph side, it doesn't look amazing. What is this? What is it doing? Provides end-to-end artificial and AI-powered advertising solutions. So advertising's like, is this another Trade Desk type of situation where it just has a rough neighborhood? Does it compete in ads with Google, Amazon, and Meta? We're gonna ask ChatGPT about this. So yeah, communication services, advertising agencies, 900 employees. Let's see, is dropping like a rock. What's going on here? It's revenue per employee 7 million, profits 5 million per. I don't think I've ever seen this. Like not even Nvidia. This is insane. Yeah, profits per employee 3 point. Yeah, this is not even. Let's just ask about let's look at some more numbers actually. So I'm curious to see what happened to the employees. Yeah, since 2022, growing massively every single kind of number. This is amazing. Yeah, not bad. Since 2018, I mean, it had a little bit of dip 2022, 2023, but it's recovered and it's pretty much on the same 45-degree angle projection that it was on the path it was previously. So shares outstanding going down. I like this a lot. Minus 1.8% trailing 12 months. Not bad. So they're not diluting. The SBC is quite substantial, 4% of the revenue, but they're not diluting. They are doing some buybacks, so we're going to take a look into that. Free cash flow, FCF positive since 2018. I like that. And massively profitable since 2023. I mean, that's kind of crazy. Yeah, the margins were broken for a couple of years. I don't know why. Maybe they did a lot of investments, high capex, something. I'm not sure. Seems a very asset-led company, so we're going to take a look into that. ChatGPT is going to answer our questions. We just have to look for questions to ask, like what's going on with this company. So basically, yeah, we don't have a lot of history. The numbers, they look amazing for this company, but not a lot of history to it. So for me, it's an unproven company so far. So I need to know exactly how they make their money. Is their moat secure? Who are they up against? Let's see some more. Net cash, total debt 3.5 billion. Net cash minus 500 million is nothing. Let's take a look at the cash flow statements. Net income $4.4 billion, and they give out 280 million in stock-based compensation. Not bad at all. Very sensible. I like it. For the margins that it has, I mean, that's crazy that they don't need to produce this kind of high profitability without employing so many talent or paying absurd amounts of money to the management. So net stock issued is minus and has been minus since 2023. So this is repurchases. Minus 1 billion in 2023, minus 1 billion again, 2024, minus 2 billion last year, and trailing 12 months, more than 2 billion. Not bad at all. So over the past 4 years, they've been doing net buybacks and consistently. I like that. Yeah, so what's left to do is just go to ChatGPT and answer some questions that we have. I mean, this was down to like $4 billion and went up to like 230. So that's just insane and absurd. And it's still, I mean, obviously something that goes up from 13 billion in 2 years up to like 230. It could go down a lot more from here because the PE is 24. With the growth it has, 4 PE is 17, but this is non-GAAP earnings, could be like 18 or 19 in reality. PEG ratio is absurd, 0.5, extremely low. This is very, very attractive to buy, but yeah, ROIC is insane, but obviously it's just not clean, you know? It's not like this, it went down for a few years, it was close to zero or negative and then went up a lot. I mean, this could have a lot of cyclicality to it and then could go down some more. I mean, this is advertisements. So when advertising budgets get cut, this could suffer a lot, or I mean, we're just going to have to see who are the competitors. So let's go to ChatGPT here. Let's ask, want to talk about app. It's down 50% from 52-week high. What does it do? How does it make its money? Who are the does it have any just trying to understand. What does app loving do? Runs AI power. Okay, that matches advertisers with users. So advertisers and users. Looks like app loving sits in between, especially across mobile apps and games. Yeah, this is what I remember about app loving, something about mobile apps and games. How does it make its money? Advertisers pay app loving to acquire customers. That makes a lot of sense. That's what advertisers do. They pay Meta to show ads on Instagram and Facebook. So AppLovin takes a cut, just like Meta and Google. Biggest competitors, Google, Meta. Oh, it's like already a rough neighborhood when you said Google and Meta. It's like, okay. Unity and or other digital advertising platforms. Unity is very weak, so I wouldn't be worried about that. Is it cyclical? Yes, somewhat. Oh, interesting. Advertising budgets are economically sensitive. That's what I said. They can get cut, especially because AppLovin's performance, advertisers reduce spending immediately when returns deteriorate. So AppLovin seems like they have some kind of performance on the dollar that these advertisers invest with AppLovin. So they acquire more customers or for cheaper using AppLovin ads, from what I understand. But let's just ask, would app acquire TTD? I am a little bit invested in the trade desk. I know this business quite well. And if AppLovin would acquire TTD, if it would make sense, then I am more familiar with this business because I studied TTD quite a lot. What's going on with ChatGPT here? It's broken. I mean, this is piece of garbage AI slop. I mean, what can you do? I mean, I have to let's see, F5, refresh now. Let's refresh the page. This is ridiculous. Yes, it could make strategic sense, but they're not identical businesses. Okay, it's historically much stronger in performance advertising, especially mobile apps and increasingly e-commerce. OCR, so they are outside e-commerce as well. So I'm not sure where would ads from app be displayed in e-commerce. Wouldn't this make competitor as well? So the trade desk, I know what the trade desk is. Open internet. Exactly. The confusing part is that e-commerce advertising does not mean the ads are displayed on e-commerce. Okay, makes sense. Right now, e-commerce companies such as Wayfair, Crocs, or a Shopify merchant can give AppLovin an advertising budget. Okay, still inside mobile games. So the ads that it shows is primarily inside mobile games and apps, inside Android apps and iOS probably as well. So yeah, philosophically, I don't think this is a very strong moat. Amazon can absolutely become a competitor. Yeah, that's another red flag as well. This is a very rough neighborhood. I mean, yeah, let's just ask ChatGPT philosophically. Use all of my give a score for AppLovin. Switching text here, toll booth, etc. So I have like 10 filters, like 15 filters, and it's just gonna, right now it used only 10 filters. So unhyped stocks philosophy score for AppLovin, 72 out of 100. That's interestingly high. Business quality, 9.5 out of 10. This part is ridiculous. Has become extraordinarily profitable. Of course, I mean, we have seen in the stats extremely high gross margins, extremely high ROIC. I just hope it goes better and better and better for them. I'm gonna do a very deep dive on this company and maybe even add it to my investable universe, but I'm not sure yet. Switching cost, 4 out of 10. Not happy about that. It can shift acquisition dollars to our Meta, yeah. So as an even I can be an advertiser. I can buy whatever. I can use whatever advertising platforms give gives me the most value for my dollar. So if I acquire more customers through Meta and Instagram and Facebook rather than AppLovin, then I'm going to use Meta. I'm not going to have any switching costs. I might use all of them at the same time and just see which is better for me as a business, and then just go with which one is best, which one gives me a higher return on my investment. There are stronger network data effects on the publisher side through Max and AppLovin's ecosystem. Yeah, failure path inevitability, 2 out of 10, makes a lot of sense. This is not like ADP or ServiceNow or VeriSign, or it's just something that offers advertising, like it's an advertising platform. It has no embeddedness to it. Tax here. So app collects just a percentage of the economic activity. 4 out of 10, very low. Toll booth positioning, 4 out of 10. Same problem. I mean, let's just say you have to go from here to, I don't know, some big city, and you have four different type of roads that you can use, and AppLovin is one of them. Google is another one of them. So it's not, the positioning is not very strong. It's not like you have to pay AppLovin to do some advertising on the internet. You can pay someone else. So competitive mode, 7 out of 10. Kind of doubt this is true. I'm gonna do some more research. But yes, is clearly doing something valuable because the margins and the numbers are just very, very good. They have this model, proprietary models that can produce better targeting. So I'm deliberately refusing to give it 9 out of 10. Okay, that can be competed away. Of course, Google can just come with a better model and some better algorithm. It's not like it couldn't be attacked or competed against. Network effects, 8 out of 10. Makes a lot of sense because more transactions create more data. Better data improves the product, and that makes a lot of sense. Embeddedness, 5 out of 10. Some embeddedness with publishers. Okay, this is an Adobe Creative Cloud sitting inside, or Cadence. Okay. Pricing power, 6 out of 10. Non-optional spend, 6 out of 10. Cyclicality, 5 out of 10. Balance sheet, yeah, is very, very strong. I mean, the margins were very high. They don't need to go into debt. They have excess cash. Really, really good capital allocation. Okay, this generated 4 billion in FCF and spent about 2.5 on repurchases. Not bad. So they don't need to actually reinvest a lot of capital into the algorithm and the Axon and Max platforms that they have. Stock-based compensation discipline, 7 out of 10. That's good. We have seen that they don't do excessive stock-based comp. AI disruption resistance, 8 out of 10. I mean, we already read that AppLovin is using AI. So it's an AI beneficiary. It's not a victim. It's not going to be threatened by AI. It is threatened in the sense that Google can make the same kind of powerful AI algorithm and compete against them. So that's a problem for them. So yeah, removal pane, some other filters that appeared here that I don't really use so much anymore. But yeah, the rest of the numbers are not terrible. They're just very mediocre, and the company is very, very volatile. Would I invest in it right now at 60% down? I wouldn't. I just wouldn't do it. I mean, I just have a lot of other better investments. Adobe, ServiceNow. I mean, there's a lot of other companies that have high growth, not the same absurd kind of growth. And by the way, this growth that it has, I mean, this is advertising. I mean, this is just not going to be like 60% every single year for the next 5 years. This is going to go slow down a lot. Okay. Actually, let's check. Why did App lose so many employees? I'm very curious about that drop in employees because a company that is growing shouldn't be losing employees. Mostly has been shrinking while concentrating. 1,700. Okay, 900 in 2025. ChatGPT also uses stock analysis for getting information. This is why I like to use both. They mostly I'm just getting the same raw numbers, so I can just ask and get reliable numbers from stock analysis. But I'm still not satisfied with this answer. Let's just ask: did it sell part of its businesses, or because? What about the margins? Maybe they acquired some company before, like in 2020, and then they had this operating margins where it was even slightly negative. So yes, the historical margin chart is massively misleading. Okay, 2021 23 was basically two businesses glued together: advertising and software platform, and then a large portfolio of first party mobile gaming studios. Oh, so they had something like Unity. So creating games and also having this was like Unity, yes, roughly. Okay, it owned a lot of mobile games and then used simultaneous operating the advertising technology that it monetized and acquired. Okay, yeah, very interesting. I mean, this is how you find the stocks to either add, but just using the numbers it's not enough. You have to go very deep into researching the business. I mean, you have to take some philosophical filters. Know what you own. Peter Lynch always says, know what you own. So you find the stock that you are interested in. The numbers look great. Go very deep into it. Can it go bankrupt? Can it get the moat? Can the moat get eroded? Can competitors just take over? A lot of different questions you need to ask. What is going to be the future for this company? Is it still going to keep growing at this rate? For how long? What is the runway? What is the cyclicality looking like? A lot of questions need to be asked before you put your hard-earned money to work and invest into something. When it comes to individual stocks, you need to be very, very sure that your money is well placed and not just you hear a bunch of news, get hyped up, and then, oh, I'm just going to invest in this because AI is hot right now. The semiconductors are hot right now. Let's just put money on Micron, which is the most cyclical stock ever. It's a commodity business, so people choose to invest, and you cannot invest into a commodity business. Okay, you can trade, not invest. Adobe or something like, I don't know, SPGI, look at this, 7% from the 52-week lows, down 30%. SPGI, that would be a very nice investment, not just to buy and hold, not to trade around. But stuff that is very cyclical, yeah, you need to either trade it. I mean, you could buy and trade AppLovin if the cyclicality seems brutal, but we don't know yet. I'm gonna keep on researching and maybe make a separate video about AppLovin. But yeah, this was pretty much it. So the screener that we used today, we're just gonna save it and say, I don't know, Unhyped 2. I already have one as well. I don't know what name to give, but yeah, you can save the screener. I'm gonna show you real quick here my watch list where I can manage my entire investable universe. So here I have my entire watch list, gross margins, ROIC, same kind of numbers that we used before, but a lot more than that. And then I can just look at the valuation and price changes because I want to keep up with what's been going down, up and down a lot. Maybe I take profits, maybe I buy into something new. So I already see today Viva Systems is at 241. So I'm planning to take profits at 250 or so, 255 maybe. So very good sign. I'm getting ready. Maybe next week, maybe this week as well, or maybe even tomorrow. I'm gonna start taking some profits before I completely close out of the company. I'm already up massively on the position. So something else I took a massive profits on is Paycom. I'm going to show you later. But this is price change in a day. And let's see, Mercado Libre down 6% today, is down from all-time high, down 30%. And from the 52-week high is down 28%. And difference from the 52-week low, 22%. Would it be a good entry right now? I wouldn't say so. It was at 1,500. It was really nice. What else is looking nice here? Doximity also jumped a lot. Uber Technology is interesting. Meta down almost a third from all-time high, and it only jumped 11% from the lows from 520. Let's see here. What else? So yeah, I'm just keeping up with my portfolio. Nothing that screams a buy right now. 52-week high. Let's see. The Trade Desk, Doximity. I mean, I already have a bunch of money into all of these. Oracle is interesting. I did buy close to like 115 or so. I kept on, started at like 130 and kept averaging down. And I already took profits from Oracle because, I mean, yeah, I don't want to be invested into something that can backfire massively. I mean, when Michael Burry is short selling something like Oracle, I don't want to be long Oracle, okay? Even though Michael Burry was very early on a lot of stuff and also late. I don't want to touch it right now because I'm already concerned myself about the CapEx spending and them having OpenAI as the single customer. They might not be able to pay Oracle back. But anyway, Zoetis, this is a huge opportunity. Massive margins. Tech-like margins. It looks like a software company is down 70% from all-time high. Down 2% more today. 52 weeks low, 54%. And is very close to the bottom of the 52 weeks low. I mean, up 3% since the bottom of 71. I mean, this is why it's one of my top positions, Zoetis. So yeah, I mean, there's a lot, as you can see here, there's a lot of features, nice features with this site that you can use. Comparison tool, you can put here Palo Alto Networks compared to CrowdStrike and Fortinet. Let's just say something like that, okay? Last 5 years price action, which went up more. What about the margins? Let's see here. Gross margins, Fortinet trumps the other two. Operating margins, CrowdStrike is negative. Fortinet is 33%, which is pretty much software-like, even though they have a hardware business as well. Profit margins, I mean, these numbers are much, much better than the two. So you can compare. I just took like the top 3 cybersecurity firms, and you can just compare the balance sheet. This is a very nice tool, the comparison tool. You can look at the net cash, market cap, and cash flows. We're going to look at the SBC. So SBC is 1.7 billion for Palo Alto Networks compared to the FCF. And when you subtract the SBC from the FCF, you're left with 2 billion for Palo Alto, a measly 350 million for CrowdStrike, and almost 3 billion for Fortinet. I mean, you can just look at a lot of numbers and say, yeah, it makes no sense for me to touch something like CrowdStrike. Someone else can have it. It's just not very shareholder friendly. Ford P 170. How are you ever gonna make money with that? I mean, yeah. So a lot of other tools. I'm not gonna make it much more longer, but highly recommend you buy a pro subscription to this, especially if you watch this video and you have learned a lot of what you can do with something like stock screener or comparison tool, because I'm going to keep on making videos using stock analysis. And if you use the same tool that I use, you're going to get better yourself as well. And it's just going to be a win-win. It's just like $10 a month, which is dirt cheap in my opinion. But yeah, that was pretty much it. I'm going to see you guys next video.